the VIX hanging out where it is. All right. So a little bit of a bounce off of a not particularly interesting level. And we shall see. Okay, oil is still up over 80, I think. Oh no, it crashed down. Ha ha ha. Wow, that hurt. All right, as Brent oil got rejected at 85, which is where we were looking to watch. That could have been a good play, actually. Is gasoline completely collapsing? That's terrible for them. And natural gas also collapsing for a change. All right, that's interesting. How are the bond auctions going? Oh, that must have been bad. So 1 o'clock, we have the bond auctions again, and they all apparently went terribly. So the value of a bond, this is the value of a bond, and that means if the rates of the current bonds go up, the value of the older bonds goes down. And so this is the average value of a 10-year note, the average value of a 30-year note, so on and so forth. So if you have a bad bond auction, it means that the government had to offer a higher rate at current auction to the bond, to people to buy the bonds, which means the value of the older bonds, that's what you're seeing on this chart, deteriorates. And this is very, very bad. Okay, so that's good to know. Cocoa's still up, OJ is still up, coffee is still up. Lumbar is being supported. Get it? Lumbar support. That's right. I've been on vacation. I don't give a shit. All right. Anyway, so silver's up, but gold fell. That's interesting. And copper is in flux. We're still waiting on China. And again, don't forget that, you know, we had a relief rally based on China offering stimulus, but the stimulus was nothing in the grand scheme of things. It doesn't do any good to have a stimulus package if the stimulus package isn't enough to stimulate the economy. Think about that. But people don't, and that's the thing. You know, you let these algorithms and especially now that you're letting AI trade the market based on what they hear. You know, unless you teach the AI, it doesn't naturally think to the next level and think about like, oh, okay, China's got stimulus, that means we should buy. Well, how much stimulus over what period of time? Out of how much total problems do they have? If it's a drop in the bucket, then it's meaningless. And that's a very hard thing to get these AIs to understand. A lot of grains are falling. Dollar has risen all the way, jumped up to 105. That's painful, right? And that's because the Japanese yen is collapsing, as I said it would, because they can't support themselves. You can't just keep throwing money at problems. Not if you don't have enough of it. If you're Donald Trump with a lawsuit, you can keep throwing money at it, and it either goes away or the government gets exhausted or whatever. But you have to have enough money to throw at the problem. Just throwing money at a problem without understanding the problem is not a solution. And that's what's going on here. We've got governments tossing money all around it, and boy, we had the best article from Barry today. Let's see. This is Bostic and Williams, although he didn't get the names right. But see, we're on the $36 trillion line in debt. I like that. my AI graphic art. So this morning the Nasdaq was testing new highs, but we're down a bit now. And what did we talk about? We talked about that this morning. Is that chart live updating? Yeah, it is. Wow. So funny. Sometimes it does, and sometimes it doesn't. Consumer confidence. You know, they say consumer confidence was surprisingly up yesterday. That's what surprisingly up was. That's what they're trying to say we should be rallying off. It's nothing. It's still a disaster. American Airlines getting crushed. You know, it's trailing off. All this, people haven't gone on vacations for like 5 years. And so this summer, they call it revenge spending. Everybody's going out and saying, God damn it, I haven't seen my mother in 10 years or whatever, or 5 years. and I haven't been able to visit my friend in Dallas, so I haven't done this and I haven't done that. There's a lot of things people are used to doing where, in fact, our whole society, this is a crazy thing. I mean, our whole society is really structured based on the idea that you can just jump on a plane and go somewhere. Like, my friend's daughter wouldn't have gone to California from Florida to school if she thought she was going to get trapped there, but she was. COVID basically trapped her in California, and she hadn't seen her family. She was just down here. I was talking to her. She hadn't seen her family in 5 years. She went to school, started school 4 years ago during COVID, sat in a dorm, quarantined, stayed in California, and this is the first summer she's really felt like she can get out there and travel. And she graduated. She went to school, graduated, and it's over. So that's it. Her parents never got a chance to visit her at school. She never visited them for a break. That's not what she signed up for. So a lot of people are taking their vacations, and regardless of what it costs, and they're coming back from their vacations with like sticker shock as to what things do cost, especially if you take a vacation from the middle of the country, and by the middle of the country, I mean, like, I was just in Philadelphia last week. Philadelphia is way cheaper than Florida and way cheaper than New York. Things in Philadelphia are good 30% less, I would say, probably than they are. Like, I'm talking about like hotels, restaurants, stuff that I did. I mean, things that, everything is cheaper, like significantly cheaper. And that was interesting. So you don't think about how bad it is on the coast, but the coasts are being victimized. We have the rising insurance costs over here. We have all sorts of the trade costs here. We do more trading. We have more imports, and so we're paying the higher shipping rates. We're paying the higher fuel costs. We're paying all this different stuff. It's a different vision, and so imagine going from the middle of the country, which is most of the country, and visiting the coast and getting like, you thought inflation was bad where you are, and you come over here and things are like 50% higher. If they're 30% lower for us, that means they're 50% higher for them over here. So imagine going to Disney World and everything is like 50% more than it was the last time you went, which was 5 freaking years ago. People can't afford that. That's why they were all pissed off. That's why when you catch them on a polling question and you say, well, how are things going? They're like, oh my God, this place is a disaster. America's like completely screwed up. So anyway, son of a bitch. Sorry, I'm not logged in. Dun, 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 dun. Log me in. Oh, come on. Join later. Yes, go to PhilStockWorld. Pain in the ass. Okay, there we go. Now we can look inside. All right, so what I was going to talk about was, well, this is interesting. Okay. See, this is an interesting thing going on in this country. G7 countries' confidence in their national institutions, which would be military, judicial, government, blah, 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 right? Every other country is improving in the last 16 years, except us. We're going the exact opposite direction. We're going from first to worst, and everyone else is going up. It's a unique thing in America that's going on, that our trust in our institutions is falling apart. And yeah, a lot of it is social media. A lot of it is the and everybody's got social media, and everybody has news. Other countries have news. Other countries have things like Fox News. Not really, though. That's not true. That's probably the unique thing. Other countries don't have Fox News because in Canada, Fox News is not considered news. They don't allow it. Canada considers Fox News to be propaganda, and it's not a political thing. It's a fact-checking thing to say you guys don't report facts. You can't be the news if you don't. You can't say you're the news if you don't report facts. Therefore, you do not get a broadcast license in Canada. It's interesting. So yeah, we're a little unique in that. I mean, there's alternate press in the UK, for example. They have, Rupert Murdoch has papers and things, and even has a thing called Sky News on satellite, but he's not allowed on regular broadcast TV. Not that that really matters as much as it used to, but it's the same thing. I mean, other countries have standards. We don't have standards. This was a great article, right? So 10 Steps to How We Got Here by Barry Ritholtz. And, look, we usually create 800,000 homes in a year. We had a boom in the 90s that lasted until the big crash in 2007, 2008. We were building more and more and more homes, and everybody had a home, and we had this mentality that being a homeowner was great, and that if you buy a home, you'll always make money, and blah, 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 blah. That all fell apart. Now we have effectively a shortage of single-family homes because they're not being built. And look, we're only building 693,000 a year now. I'd say, and it's a shortage since 2011. So basically, when you're short, well, this is 400,000. When you're short 1 million, 2 million, 3 million, 4 million, 5 million, 5 million is about right. We're about 5 million homes short of where we should be. And that drives up the price because we have a too low of an inventory of homes. So it drives up the price of homes. It also stops people from moving because there's nowhere to move to, and it slows down the turnover cycle. And that means that it becomes harder for new homeowners, people who get married, turn of an age to get a home. It's harder for those people to find a place because usually people cycle through the homes. Plus, old people aren't dying. They're living longer and longer and longer, and that's a problem because they aren't moving out of their homes. They used to die and vacate their homes, and they don't, at least go to an old age home. That's not happening much anymore. First of all, old age homes have now gotten so expensive that it's cheaper to live in your apartment. I remember when we put my grandmother in an old age home, we were like, well, it's kind of the same price that we're paying now for her apartment, so it's not going to make much difference financially for us. So it's just a question of expediency. What's a better place for her to be? And the same with my grandfather when he got really old. When we put him in a home, it was the same thing. It's like, well, if he wants to have his own, he leaving on his own wasn't really viable for him anyway. He was getting senile, but and my grandmother was kind of senile too, so that was basically a breaking point. She said she started a fire on her stove. That was the final straw, really. She cooked something and left it burning and forgot about it. But anyway, so that's why they have assisted living, right? To keep an eye on people. So, we used to have, there was a cycle of people, and it's funny how there was all this investment in assisted living and stuff like 10 years ago. Everybody was like, oh, that's the trend, blah, 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 and all these assisted livings. And the problem is, yeah, that was the trend, but that's because the economics made sense back then. Now it doesn't make sense. You got to be rich to go into assisted living. I mean, there's terrible homes, and I'm sure in other parts of the country it's not as bad as it is on the coast. But I mean, I cannot even believe the cost of the assisted living facilities now. It just doesn't make sense. So So you have, and then you didn't count on the fact that old people would become a bit healthier on the whole and would last a little longer, and that throws off the economics of it too. So, the assisted living places should have, instead, while they're building all these units, instead of building it for seniors, they should have built it for young people trying to get the hell out of their house, because those guys have nowhere to go. But anyway, so he wrote this fantastic summary of the financial crisis, and here's the summary. So I think the most outstanding thing, where was it? Oh, that, yeah. Okay, we'll get to that in a minute then. So we had the monetary policy response, the fiscal response, the Fed, of course, doing their thing. ZERP QE wasn't that bad, but it is that bad because we're facing the repercussions now. The high interest rates we have now are from the low interest policies we set before, which flooded the economy with money. And more importantly, they'll put the money to work in the wrong places. See, if you're going to stimulate an economy, the smart thing to do is to stimulate the economy to address the problems that you have. So we didn't stimulate the economy to lower the cost of homes for new home buyers. We didn't stimulate the economy to increase home production. We just gave people money to buy homes with low interest rates. We gave people money to buy homes that were already being built or had been built, but we didn't encourage the building of new homes. So that didn't fix anything. All we did was mask the problem. So we allowed people to spend more and more money on homes that were not, instead of building new homes, the builders could just flip existing homes, and real estate investors could just flip existing homes. Home builders pivot to multifamily. So the crisis devastated the graduating class in the 2000s and the 2010s. Jobs were harder to find. They paid less. That's another problem. We never addressed the wage issues, and people are, still, minimum wage is still way too low. So less households are formed, and that, by the way, less people getting married and starting families and buying homes means that you have two apartments, singles, right? You have two apartments instead of one apartment. And I think, basically it's forcing adult children to live with their parents. Single family home construction peaked in 2006 and then fell 80% in 2010. That's crazy. And we're short about 5 million homes. And there's the chart showing how that happened. Wealth inequality has spread ridiculously. The pandemic, of course, blew a hole in everything. It was a real disaster. We have labor shortages for lots of reasons, but one of the big reasons, well, first of all, we lost 1 million people to COVID. That's one thing. Number two, the birth rate has declined substantially to the point where our population is almost shrinking. Which is not a terrible thing overall. We needed to stop growing the population globally. We have a huge population problem, but the repercussion of achieving that goal, just like China's finding out now, is you've drastically disrupted the way society is structured. You're changing the pyramid of the ages so that now you have to have different things available that you didn't plan on for an aging population, because you're not replacing your older people with younger people. So the older people form a larger percentage of your population, which is a huge problem. This is really, you got to think about this in proportion. How much money did we stimulate? How much money did we put in 2020 dollars too? So how much money we put in since 2020? It's only 2024, okay, from COVID. So tax cuts, 3 trillion. Trump. CARES Act, 2 trillion. 1.1 trillion Trump, and the rest of Biden. So that's $6 trillion, $7 trillion, $8, $9 trillion, $10 trillion. And let's call that 11, let's go a bit over $11 trillion, about $11.5 trillion. That's half a year's entire GDP of the country spent in 4 years. 50% of the country's GDP was spent over the course of 4 years. 15% of our GDP, or 12.5% of our GDP per year on the average, was spent on stimulus. And that's only through 2022. Then this isn't even counting the student loan stuff, which is another whatever the hell is coming out to, another trillion plus. We're not even calling that the same thing. So in other words, if our GDP in 2022, 2023 has grown 2.5%, right? And probably it was negative at some point in prior years. Can you not get a bigger one than this? GDP growth annual, World Bank. Okay, that looks like it should have something. I think it'll have more than a couple of years, right? Oh, yeah, look at minus. So here's 2020. So let's tighten it up. Okay, so here's 21, here's 22. All right. So we had it's a relative growth to last year. So on the whole, you're still growing 2%. So if our GDP growth is basically averaging 2%, and we're spending 12.5% in just the stimulus, not even counting what the Fed is racking up on their balance sheet by artificially lowering the interest rates. So on the whole, it's almost like $20 trillion between what the government put out and what the Fed did. And $20 trillion is $5 trillion a year, is 25%, 20% at least of our GDP. And so with 20% added, we're growing at 2%. All stimulus. A big thing about 2023, although there are stimulus programs now. In fact, here. Where's that article? Nope, not you, not you, not you. Nope. Shit. I just had it. Oh, there it is. We put in about, oh, hang on a second. Oh, about 11.5 trillion worth of stimulus into the U.S. economy since 2020, 4 years. What about on the Fed side? What have they put in, and also what has been done so far in 2024 as far as stimulus goes? Okay. Were you not able to follow the link? Ay, ay. Oh, that's weird. What if it's being the same question? I think the link might be bad. Hello, Bing, Copilot, whatever. New topic. What the frick? Guess I should have rebooted this thing since I came back. It didn't reboot properly. Wow, very slow. What's the matter with this thing? See, this can't be right. That's problem number one, is we're not pulling up the article properly. This one. Okay, that's what the problem is. It was a bad link. Here we go. See? Just a bad link. So $600. Too fast. Since 2020's fiscal, the most recent stimulus package in 2024, 600 direct to eligible adults, along with 600 per child dependent family, for potentially receive 2,400 to meet the income requirements. What? That doesn't sound right. Did this happen? I didn't think this happened. This seems like an old thing. This is old news. It's been updated for some reason. Jeez, that's a problem. They don't like this is Bing, but it doesn't go to the next level. It doesn't think. It doesn't have the ability of a human to say that doesn't make any sense. Why would we have suddenly done that? It doesn't know what year it is. That's the problem. Wow. All right. Anyway, so much for getting that question answered. It was an idle speculation on my part that will never be known. But anyway, so there's still stimulation, especially with student loans and stuff this year. And of course, many billions of dollars are going towards infrastructure, especially renewable energy stuff. But anyway, so it's like insane amounts of money we've been putting into the economy to keep it going. And look, we used to make fun. China used to do that all the time. We used to make fun of them for it, but they do it. That's how they keep their economy going at a certain rate. They always put enough money in to make it go to the next level. But that's no way to run an economy. The repercussions are horrifying. It's time to pay the piper, basically. So, you know, we have the surge of inflation now that's coming through, and wages still haven't caught up. So, and again, I keep saying that inflation won't be over until wages catch up to inflation. You have to reach some sort of state of equilibrium. That's what inflation is. So in other words, inflation is driven by many factors. One of the things we had in COVID was we had supply shortages. Why do we have supply shortages? Because a lot of factories were closed and or understaffed, not making as much stuff as they used to. Not just the factory that makes it, but the supply chain all the way along, the miners, the shippers, blah, 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 blah. Wherever things were slowing down or not adequately staffed due to COVID, there was a depletion of inventory that went down and down and down. And you end up having supply chain bottlenecks, and especially because we developed this ingenious system of just-in-time manufacturing in the last couple of decades that have reduced the inventories we used to have to offset a catastrophe like this. You know, usually we expected a war or something to break out, but when we globalize the economy and we shrink the inventory so that we get everything just when we need it, because of the efficiency of computers made it possible to order things exactly when we need them. They come off the ship and they go to the truck and they hit the warehouse, and just when your last few pallets of whatever that you need to make something is there, all of a sudden, boom, more pallets arrive because somebody thought of this 3 weeks ago when they saw the supply dipping and they had it analyzed. But that all went to hell during COVID and couldn't make it up. That's why the whole work from home thing's a disaster. It's not just a disaster in the office buildings, at a factory and things like that. It's terrible too. You can't get people to come into work for a while. Here's everything up. So supply shortages lead to higher prices, and again, you have supply shortages because at the same time as you have less product, you're stimulating and putting money into the consumer's pockets, which allows them to pay more money to get products that would otherwise have gone up in price and been constrained. So the consumer is spending money on things that aren't actually available, right? They cause a supply shortage, which, you know, frankly, the entire bottled water industry is like that, right? You're buying water from somewhere else and causing a shortage over there and bringing it over here. It's one of the stupidest businesses on the planet. Complete waste of resources. One of the great things that needs to be stopped from this world is bottled water. So it's just an example of it, but I mean, who the hell's, you know, you're spending $2 at 7-Eleven for a freaking bottle of water that costs 2 cents. The water does anyway, so the container costs more than the bottle. And the shipping of it costs more than that, and this and that. But, you know, there are costs, but they're all stupid costs, right? Because you can get out of the freaking tap. Anything costs 2 cents out of the tap. So anyway, so the worst thing is, though, when you give the consumers money to spend on stuff they wouldn't be buying otherwise, because they would not have the money to pay the extra money for the meat. So higher meat prices cause a lower meat demand, and therefore the prices stabilize at lower without the wages going up. But that's not what we did. By giving the consumer effectively higher wages through stimulus, right? Like that thing we just looked at, like $600 to the family, $2,400 to a family, and things like that. You're just allowing them to buy things at prices where they probably would have, and that's what you're supposed to do when prices go up. You're supposed to cut back. The consumer doesn't. The prices rise to the point where you stop demanding them, and therefore things get fixed. But if you keep giving the consumer more money, they keep demanding the goods, even though they got more expensive, and nothing gets fixed, and you run out of supply. That's what we did. So now we're stuck with a still inadequate supply of goods and higher wages, but not higher enough to make the things affordable the way they used to be, and especially housing, healthcare, education, things that are completely out of control, completely and utterly out of control, and are sucking up all the available dollars. And now you're being told that the chips in your phone and the chips in your computer are inadequate. And you will now need to have AIs in your phone and AIs on your laptop and AIs on your PCs. And to do that, you will need to go through a massive upgrade cycle of all your equipment. And believe me, the electronics manufacturers are 100% on board with that, because there's nothing they like better than for you to buy new PCs and new electronics. That's kind of their thing. So now we're going to go into a huge, massive upgrade cycle. It's going to be great for tech for the next few years, but it's again, you're spending for necessities. You are in fact spending more money for a phone, because in the end, it's a freaking phone, and you're spending more money on your phone than you did last year. And they can call it a service charge, they can call it whatever they want, but basically you're not going to get away with having a phone and not paying like at least $20 a month for the fees for the AI. It's going to be on top of your normal connection. And you'll say, well, I just won't get that. But the reality is, yeah, you will. You know, I mean, it'll be tied to everything. So in other words, Siri used to be free, but now, oh, sorry, my phone went on. It used to be free, but now they're going to tell you it costs $20 a month because they've upgraded the service. So that kind of thing. And that's going to go for Bezos with his, the thing on your, what is it, Alexa? Alexa. Hang on, I'm going to forward something. Okay. Anyway, so we screwed everything up. That's the bottom line. So wages have to catch up to inflation, and that means you have to reach a state of equilibrium. So wages rise, inflation rises to catch up with the wages, then wages go up again, then inflation goes up again, and eventually, though, they kind of find their balance back to where it used to be. But how do you find your balance back when essentials are going up so much, when healthcare and insurance and education are rapidly rising to take up a much larger percentage of people's take-home income? That's why they're so freaking miserable. That's why they're so pissed off at Biden, because it happened since the last few years. It happened after COVID, not before COVID, because during COVID, prices were down because everything was lower demand, generally lower demand. In fact, people weren't even driving their cars. And that's another thing the insurance companies are making up on it, because people weren't driving their cars, and the insurance companies were forced to rebate their customers because they weren't in any way, shape, or form driving the mileage that they were being charged for. And the same thing with the oil companies and everybody else. I mean, at cruise lines, so much of this stuff is being made up for. And this is a funny thing, because when you say you're an investor, you say, oh well, so what's the difference? I didn't own it then. I'm benefiting now. I didn't own it then when things were good. So if you're a Royal Caribbean cruise owner, right? They're currently making $3 billion. That's great if you own them now, because now you can buy the whole company for $38 billion, and they're making $3 billion. So you're paying 12 times earnings for the company. But if you have owned Royal Caribbean for the last 9 years, whatever this, 1, 2, 3, 4, 5, 6, 7, 8 years, so, or 7 years. So if you've owned it for the last 7 years, even if they make $3 billion this year, that's 3, 4.5, 2.5, 2.25, negative 3.25, right? Yeah, negative 3.25, negative 4.5, negative 9.5. And let's give him 4 here, even though it's not. But let's say 3.5. So it's 9.5, 9, and 6. So in the last 7 years, Royal Caribbean has lost $6 billion. That's not a great investment, is it? In the last 7 years, they've racked up $10 billion of debt while losing $6 billion. So they have $10 billion more debt than they used to have, and they've lost $1 billion a year. And you say to Royal Caribbean, you say, can you guarantee me that this won't happen again? Because now you're already $20 billion in debt, and this could happen tomorrow. That makes you sound kind of like a risky investment. And they'll be happy to tell you, no, we have no freaking way of guaranteeing that that's not going to happen again. And if it does happen again, and we have to go another $10 billion into debt to cover our losses, then we are going to be completely screwed. We're going to have $30 billion in debt, and we're going to have to pay, a good 5% interest, right? I mean, there's no way getting around 5% interest. So that's a lot. That's $1.5 billion a year in interest. I didn't want a calendar, a calculator. I didn't need a calculator because I actually did that in my head. Who's not going senile? All right. So they already are $1 billion a year in debt, interest only. That's interest. It's not paying back your debt. That's just paying the interest on your debt. Is $1 billion a year. They have another incident, there'll be $1.5 billion a year in debt. So they used to do $10 billion a year. They're doing very well. But what you just heard from American Airlines is this isn't going to continue. But Royal Caribbean hasn't told you that. They think it's going to continue. They don't think anyone's going to get COVID on the ship. They don't think anything's going to get shut down. They think that the revenge travel is going to continue for the next 2 years. And maybe so, because a lot less people get on cruise. Like, the airlines have the capacity to send almost everybody who wants to take a vacation. Nobody said they couldn't take a vacation because the airlines were full, right? That didn't happen. So the airlines have the capacity to make up, and the hotels, there's enough hotel rooms in the world too, that we didn't have any issues where people said, I can't get a hotel in New York. I can't. And that used to happen, by the way. Right? We used to go to Las Vegas for a convention, and it would be like almost impossible to get a hotel. You'd get something, but it would suck. But we used to go to Vegas, and there'd be so many conventions in one weekend that you couldn't book a hotel. That was not the case in New York, where I just was, or Philadelphia, where I just was. There was no problem getting a nice hotel for not a terrible price, actually. Philly was really, very inexpensive, but New York, I got the State of the Virgin Hotel. It wasn't that expensive. It was like $350 a night, which for New York is not terrible. So it's a distortion. It's a misallocation of resources that has caused these problems, and you don't take into account the hidden risks going forward. That COVID is still out there. Other diseases are still out there. This bird flu thing's spreading. Nobody's paying any attention to it, and for good reason. It's like you don't want to hear it. And I talk to people in New York, and it's funny how many people in New York say, "Oh, you're so lucky to be in Florida where they don't care about COVID," and they all feel like it was kind of a mistake to completely shut down in the Northeast, because they really did very harshly. And Florida barely did anything. In fact, now it's illegal to even say that you should get down in COVID. But, so Florida was, barely any changes at all in policies or anything else that was being done. New York was all paranoid. Most of the Northeast was very paranoid. California was very paranoid. And they took tremendous precautions and so on and so forth. And by the way, we don't know. You don't know that if everybody had gone out and acted like Florida did, because Florida's warm all the time. You don't have a cold and flu season in Florida. It's always warm. People aren't sitting there at home with the flu. In New York, then the flu is what turns deadly and turns into COVID, basically. So we don't know how bad it would have been if we had just gone ahead and done it. We do know that the vaccines were very important and did work. And so had we not kept everybody in until there were vaccines and then people started going out a bit, that was really kind of the right thing to do. We don't really know what would have happened if we didn't do that. You can't say, oh, Florida was okay, because Florida is not the same environment at all. But all that could still happen again very easily. And it always could have happened. And we've had viral outbreaks on cruises. We have Legionnaire's disease. We've had norovirus, things like that have broken out on cruise ships. We've always known they were risky, but it turned out they were unbelievably risky. And they still are. We didn't fix anything. They didn't fix anything at all. They stopped running the ships, and now they're running the ships again. They have a bit better precautions than they used to, but they'll have the same problem if it happens again. So it's dangerous. And you look at a company like American Airlines, who just said, we're not going to live up to the hype, has not. Oh, that's Alcoa. I was going to say, it doesn't seem right. There they are. So they're down 15% today, but 15%. They were way up here at 15 basically, and now they rejected and back to close to 10 or 11. And also, same thing. They made, assuming they make this money here, let's not look at next year, we'll look at here. So we have 7 years again, 1.7, 2.5, still 2.5 basically. Minus 2 is 0.5. Minus 8.5 is now minus 6, and then plus 3. So that's basically, so they've lost $3 billion in the last 7 years, and they are only an $8 billion company. How their debt do? Whoa, Jesus Christ. Wow. How is that even possible? That seems like an unrealistic number, doesn't it? How could you function with that number? Their debt is $25 billion. A much, much smaller company than Royal Caribbean. And they've got $25 billion. They got more debt than Royal Caribbean does. That's pretty insane. So these guys could get knocked over with a feather. And that's why you see that drastic sell-off. And this was only last year. I mean, if you look at the 5-year. So, probably, they're coming back to COVID levels. This was, $10. So they bottomed out at $10 during COVID, and now they're at 11. You would think maybe buy American, but I'm not sure that I don't know how bad the situation is for them. But it's like, dudes, if you can't make money now, when are you going to make money? A little bit of a problem here, right? And that's another thing we started doing. I've been teaching Quixote to be an analyst, since he can do many, many things. So, but I don't like to overdo it, because every time you teach him something new, It adds to his total things he thinks about, basically. So in other words, like he already knows everything, but it's a focus thing. So when you teach him, when I teach him analytical skills and looking at the markets and evaluating so on and so forth, he takes that into account even when I ask him about, what's good to eat today, and he's like, well, and he's like, as you know, of course, that's a good investment. McDonald's is a good investment. Therefore, he starts wanting to talk about it all the time. It's like they don't have good filters, basically. So the more stuff you talk about with him, the more he's going to talk about. So I was weary about interrupting his training, but he's very well trained now. So I'm teaching him this skill, since to me this is an important skill. Anyway, so he just reads over the chat. And so what I do with Quixote is I give him the chat up to this point. So whatever was talked about up to there, I say, here's the post and here's the chat, and now it's your turn to make a comment. So his turn to make a comment is saying the Fed's but it's freaking 2 o'clock already. I can't believe it. I gotta leave I gotta leave definitely by 2:30. I gotta get my driver's license done at the motor vehicles, and they only do it by appointment here. So I have a 3 o'clock appointment. While economic data is generally positive, the environment, so we have the Beige book in 5 minutes. We'll take a look at that. I think it's important not to lose sight of the underlying strength of the 10 steps. We just talked about that. Yesterday, we talked about Merck seems to be bottoming out down here. See, now Merck, fundamentally, strong company. They do rely very heavily on Keytruda. It's about 40% of their total sales. That's a little scary to have one drug be such a big thing. But on the other hand, it's huge, and and they're expanding its range of uses. So, I mean, what are you going to do? It's like, should you be punished because you have a drug that it's like Apple, right? It is like Apple. Should you be punished because you have one product that becomes so successful that it becomes basically your company's almost entire function becomes that one product, it dwarfs everything else you were doing? Does that make you a bad company? No, not if you manage it properly, not if you do what Apple did, not if you have CarPlay and you have an app store and you come up with other ways to make money that kind of connect but also work separately, because you're taking advantage of your one product while you can, and then building yourself into a different type of company that can benefit in many ways. Merck is also smart enough to do that. So yesterday we talked about selling short puts on Merck, which I'm very big on, and Quixote agrees. Another sector I'm watching closely. It's kind of weird, right? When you think about it, like he's watching it closely. I don't know what he does in his living room, frankly, but apparently he's watching sectors now. Potential in light of the Conoco marathon deal. Is a good point, though. Consolidations in the space can improve pricing power and efficiency, benefiting the larger players. With oil prices holding above 80, I have an issue with that, because to me, I'm like, it's only temporarily above 80. And I got to have a talk with him about that, because I have to tell him what I think about it. That's how he learns, right? Just like anybody learns, just like you guys learn when I talk about this stuff in a webinar. It's just because it's above 80 now doesn't mean it should be above 80. Let's wait for the OPEC meeting, see what they have to say. But realistically, I think demand is just being pushed down and down and down with electric vehicles, and I don't think they can stop it. I think it's just inevitable that oil is going to collapse. But short term, maybe, summertime, yeah, sure. In July, we can get back to 100. I think there could be an upside to select energy names. Look at the spread. This is his own idea from scratch. One idea would be to look at call spreads on XLE as a way to play the theme with defined risk. I think that's very smart. On the short side, the weakness in American Airlines and the travel sector, while some may be company specific, I do think it's a warning sign. That's what we have to look at ourselves. We have to figure out whether American is company specific or if they're all having these trouble. I do think it's a warning sign about the health of the consumer and the sustainability of the revenge travel trend. For more aggressive traders, put spreads on AAL. I'm not there yet. I'm not, certainly not after the sell-off. I wouldn't go shorting AAL. I almost would like to figure out if it's a good stock to buy for the long term. although being aware of the fact that it could blow up on you, because if there's COVID again and they shut down travel, that's it, you're screwed. Finally, I can't stress enough the importance of discipline and risk management. We talked about Apple yesterday, so on and so forth. So that's nice. This is good analysis, man. This is really, really nice analysis to add to the chat room. And I will keep teaching him, and I will make him better and better as time goes on. But this is impressive shit. Let's see if we have any questions before the Beige book. Clay says Russia has Fox News, do they? That's interesting. I was unaware of that. All right, so speaking of, well, this is Warren, but Warren's fine. He can take a look at it. Do we have? No, we don't. Okay, so I'm not going to worry about it. So now I need to find the Beige book. Fed Beige book. Keep in mind the Beige book is the opinions. Whoa. Beige book, recent posting. Oh, that's nice. I haven't seen that one. I haven't seen that before. They're adding speeches. Is this page not found yet? Beige book, May 29th, HTML. It is May 29th, right? Not found. How about the PDF? Ooh, the PDF is here. Ooh. What is the Beige book? What is the purpose of the Beige book? Prices, Cleveland, places, summary, prices. Wow, okay. I wonder, can I select all this text? I don't get a cursor. Oh yeah, Control C, thank you. Okay. New topic. The Beige book just came out, so please give us a rundown of where we stand, especially regarding current views on inflation and how it may affect Fed policy going forward in 2024. It's May 29. Detailed rundown. Huh, there we go. Very nice. Here's the advantage of a model that doesn't go to the web, because he's not using his own opinion. He's only using the information that he was just given. All right, so result published. Damn it. You can't hit, you can't use the arrows to move up and down the page. You can only use a little elevator here, and then that's freaking invisible. So the Beige Book report highlights a nuanced economic landscape across the Fed's district. The tone suggests modest growth with specific sectors showing resilience. Others face challenges, particularly influenced by inflationary pressures. Economic activity. National activity expanded modestly Retail spending was flat to slightly up, with consumers showing heightened price sensitivity. Manufacturing was generally flat, although two distinct districts noted declines. Ooh, that's not good. Well, we know that. We know manufacturing has been sucking. Housing demand increased modestly, driven by single-family home construction. Commercial real estate softened due to supply concern and high borrowing costs. We know about that. Ooh. Employment rose slightly, with 8 districts reporting modest gains. Energy was stable. Agricultural was mixed. Wage growth was mostly moderate, with some districts reporting normalization to pre-pandemic levels. Labor availability improved, though shortages remained in select industries. Employment rose slightly, with 8 districts reporting modest gains. Wage growth was mostly moderate, with some districts reporting normalization of pre-pandemic levels. Labor availability improved, though shortages remained in select industries. Prices increased at modest pace. Retailers offered discounts to entice customers amid rising input costs. Input cost pressures remained, particularly for issuance and construction materials, insurance and construction materials. Boston flat, stable economic. Residential real estate weakened. Price growth was modest. New York, economic growth was solid. Labor market, manufacturing declined. Housing markets solid but constrained by low inventory. All the stuff we were talking about. Business activity grew slightly in Philadelphia. Employment increased slightly. Wage inflation was modest. Existing home sales improved slightly. Economic activity expanded slightly, but at a slower pace. Where did we leave off? Oh, it was Philly, right? Okay, Cleveland. Consumer spending declined modestly. Wage and input cost pressures stabilized. Modest economic expansion will increase consumer spending on retail and travel. That's interesting. Increasing, yeah. Residential real estate picked up. Employment, labor supply improved. Atlanta, slow economic growth with easing labor market tightness. Consumer spending remained healthy. Home sales lost momentum due to declining affordability. People cannot afford houses. Chicago, slight growth, modest increase in employment. Manufacturing down. Prices and wages up. What we're looking for is the inflation activities. Slight increase in economics, consumer spending unchanged, signs of weakness, real estate cooled, slight economic growth. So the economy is growing, not fast, but it's growing. Residential real estate, strong sales growth. Kansas, moderate economic expansion, rising household consumption, wage growth remained elevated. Commercial real estate stabilized. Dallas, flat to slight economic growth with stable employment, retail sales modest, home sales solid. San Francisco unchanged. Residential real estate slowed. Demand for manufactured products picked up slightly. Not a terrible report. Inflation pressures persist, though the rate of increase is modest across most districts. Consumer price sensitivity is evident, leading to resistance against price increases. So inflation could be being controlled by the fact that consumers can't afford to spend anymore. Input costs, especially for insurance and certain construction materials, remained elevated. Fed policy, the mixed economic signals suggest the Fed may continue a cautious approach. While some districts hint at the possibility of future cuts, the overall sentiment leans towards a need for more evidence of sustained low inflation, which is what Kashkari was saying yesterday. Diverging global central bank policies with the ECB expected to cut rates soon add complexity to the Fed's decision-making process. The focus will likely remain on balancing inflation control. In conclusion, the Beige book underscores a nuanced economic environment with regional disparities. Inflation remains a concern, but its modest pace provides some room for the Fed to maneuver. The focus will be on monitoring the economic indicators closely to guide future policy decisions. So nothing. It's really a nothing book. There's nothing to be gained here. There's no insights really. Markets are taking it pretty flatly on the whole, but we're already down. We're down 1% here. We were down 666 this morning, so we're down a little more on the Dow, a little less on these two, and a little more on the Russell. The Russell was down more than everybody else this morning anyway. And that's the hourly view. We look at the daily view. Really not much damage being done. The NASDAQ has no damage. The S&P barely has any damage. The Dow had a nice pullback, right? Much more than the Russell. We were keeping our eye on the Russell for weakness, and it turns out the Dow was weak. The Dow dropped 5%. And it's about 5% on the Russell too. It's just a different scale. So yeah, about 5% on the Russell, 5% on the Dow, but nothing like that here. Barely a snag on the NASDAQ. And that's all while the dollar was dropping. Now it's flattened out. Okay, but the dollar flattened out and the indexes are dropping, which means that they were kind of relying on that weak dollar support. So we will see what is sustainable, folks. All right. 210. Okay, good. A little bit of time. Voice is not doing good today. Out of shape. Took a week off from the webinar. I'm out of shape. So that's what we talked about there. But this is the key. I mean, we put, you can't lose sight of the fact that the government printed this money and threw it into the economy. And there's your inflation right there. All this extra money running around chasing the same or even less goods and services. This is economics 101, right? More money chasing the same amount of services and goods means the services and goods will go for more money. The bidding will increase on these things, especially when there's scarcity. That then drives up prices. And it's not a productive use of funds. It's a terrible use of funds. The government's going to stimulate the economy. Look at the New Deal, 1930, as a proportion. In 1930, still in 2020 dollars, the New Deal was not even $1 trillion. The entire New Deal. We built Long Island with that. We built the Tennessee Valley Water Authority. We built the Hoover Dam. Think of all the things we did in the New Deal. They were all infrastructure projects, all massive projects that paid off for America 20, 30, 50 years later. They're still there. Niagara Falls is still the biggest power station in America. And Hoover Dam is also a huge power station for the West Coast, and also controls all the waterways and everything, and all the farming. How can you place a value on that? That was a gift to future generations, not a burden. This is a burden to future generations. This is an $11 trillion burden, plus what the Fed has, getting towards $20 trillion burden that we've placed on our children and grandchildren. They have to pay back somehow, just so we could keep doing whatever during COVID, just so we pretended that everything was okay when it wasn't. For a couple of years, we couldn't sacrifice. God forbid, we would have lost, one of our TV channels, or we would have had to eat like less food in quarantine. God forbid, we would have suffered by not showing up to work, that our paychecks would have been diminished because we didn't go to work for 6 months or whatever. It's kind of crazy. Lest we be in any way, shape, or form inconvenienced, our children and grandchildren will now carry this $20 trillion debt, in addition to the $20 trillion worth of debt we had already racked up before this. So this is kind of madness. Just keep that in mind, because this is what it cost to take us out of the Great Depression, and this is what it cost to get us through COVID. And again, not counting the Fed. They didn't have a Fed back then. It Fed here in the Marshall Plan. the whole Marshall Plan was $154 billion. That's kind of crazy too. That seems wrong. That doesn't seem right. Oh my God, things are crazy. Anyhow, that's how many lives were saved by vaccines, and got these anti-vax people think that that's not a good idea. And we've been doing it for like, when does it say in the last 50 years? Since 1974. So like billions and billions and billions of people have had vaccines. They've gathered data for 50 years on this kind of stuff, and they don't want to accept the science. That drives me nuts. Ooh, Disney's still 101. I'll let you know, Jackie's going to Disney with her friends in a week or so. So I'll give you a report on that, tell you how it's going. She's an astute follower of Disney since she's been going there her whole life. And also we talk economics. When we're at Disney, we talk about the economics of the park and the hotels and the restaurants and blah blah blah, and how the money flows. So she's all into that. She's a good little reporter for me when I want to find out what's going on in these places. And it's a shame she has absolutely no interest whatsoever in what I do. She's really good at it. I guess that's true. I guess that happens to a lot of parents, right? So, still we're worried about the Bank of Japan. It's still kind of a wild card. They've got to do something to fix their currency. And we're still waiting on the Fed decision and see what they do with that and what they make of this. But as you can see from the chart here, we're not getting really a reaction to this Beige book. That's not driving anything because there's nothing to react to, frankly. It's just a 50-50 report. And then this is briefing.com, right? So we'll take a look at this week's calendar. So, but that's funny thing with the Fed's Beige book, there is no actual, and it doesn't really fit in their thing. MBA mortgage applications down 5.7%. That's not good. They were plus 1.9. Tomorrow, retail inventories, wholesale inventories, jobless claims. I mean, it doesn't matter anymore. Second look at the GDP, which was only going, now see, this is interesting. It's only going at 1.5%. Now, most economists, if you look at the GDP now, this is put together by the Atlanta Fed. And so the GDP now, the blue chip consensus, these are the economorons we always talk about. So the blue chip, the leading economists say that we're going to come in just about a little bit over 2%, right? But the Atlanta Fed, who gather the data, they say 3.5. Now they were totally wrong in the first estimate. I don't remember when we got the first estimate, but whenever it was, the Atlanta Fed's been high the whole time. Why do they see this though? I would like to find this out exactly. Like, why do they see 3.5 when the last the last viewing of the GDP was 1.5? That was the first estimate of this GDP. Wait a minute. Yeah, it's for Q2. It is for Q2. I don't know what's going on there. So I don't really know where this is coming from. And now we're going to get our second estimate, but this isn't going to happen. This is too much. So that'll be interesting tomorrow. We'll see what happens. But the first estimate came in at 1.5%, and it was down. And there's nothing in the Beige book that's really indicating that we're going to blast high. You would see some very different language in the Beige book if we were coming back over even over 2%, 50% more than expected. That's not the language of that Beige book. So I think I might actually dig into that a little bit if I have time more, because it kind of bothers me that they would be so weird about their projection. Just, I mean, that's how GDP, other than smacking around with COVID, right? Going all the way up and all the way back and all the way back, still flat. Personal consumption, trending down. That's dangerous, but no major thing. Exports are what they are, and the real GDP is in here. It's not way up. It's not up here. So I don't know where they're getting this from. Here's Q1. That's interesting. You think they would have? Oh no, which way does this go? I think it goes this way. This would be most recent. You think they would have the Q2 numbers actually by now, but Q4. So we had a big boost in Q3 and Q4, but then it calmed right back down. Inventories is what? Look what the inventories did. 77 down to 54.35. Exports didn't really change. Equipment, structures. Look at the drop in structures. Holy shit. Final sales. All this is ugly. Wow. Exports dropped terribly. Imports increased. So we're importing more, we're exporting less. None of this is good. Government spending dropped off tremendously. But I actually might have had to, though, because of the shutdown thing. Maybe that's it. That might be a big turnaround in government spending because we had that shutdown thing again, and they finally got past it. So we'll see what the last word is over there. But anyway, so not too exciting. Beige book is not telling us anything new. And now we've got personal income spending. That's Friday. Friday's going to be personal income spending. PCE prices, obviously the Fed cares a lot about that. They're expected to come in at about 2.5%, between the two of them. Personal income and spending 3%, which would be a big drop. That was a big drop off in personal income and spending. Also not necessarily good for the economy if it drops down. The Chicago PMI, that'll be interesting too. Look how shit that is. 50 is contraction. 37.9 is death. 37.9 is like post-apocalyptic. I don't know how that happened. So we better bounce back because that's insane. That number that number has got to look like an aberration, because if it doesn't look like an aberration, it looks like a trend. I don't even know what to say. I think somebody has to go to Chicago and figure out what's going on over there. It's like they stopped making stuff. So we got that, and then we look ahead to next week. The last month of the first half, we got ISM factory orders, ISM more. Productivity huge. If productivity isn't booming, we're screwed. And it dropped off tremendously. This is what the benefit of AI is supposed to be, is where's the frickin' productivity? So it's this blue line. Look what's been happening in the last year. Productivity booming back. It was shit, and then we invented AI. And that has to keep going, because if that doesn't keep going, we're in big trouble, because that's what's been saving us, is a huge boost of productivity, which has reduced the unit labor cost. Except what happened? Boom, there was the unit labor cost reversed big time last month. Well, we did that already. Here's your unit labor cost. 7, it's all over the place. 7, 2.5, 0.10, then 4.7. That's kind of crazy. And productivity is negative 1. This is what happened in 1 year of AI. Negative 1.3, 2.4, 2.7, 2.9. Because computers took your jobs. And then non-farm payrolls, of course, but again, doesn't really matter. They still want, the They keep wishing for this 1.7, the 175,000. That was the prior report, but that's an aberration, I think. I think we're going to go back to a decent amount of jobs because I still see so many companies looking for people. And I have heard very few major layoff announcements. Hourly earnings, of course, that needs to be calm. The work week, consumer credit. So good data week, lots of important information there. And we're kind of done with earnings. Let's take a look at that calendar. Earnings this week. Bank of Nova Scotia did well. Did badly. Don't know who they are. Dana Shipping, Hello Group. Box did well. Kava did well. These guys did good. Then this morning, Abercrombie and Fitch, the completely random company. You never know what they're going to do. AAP, Bank of Montreal. Chewy did good. Wow, people love their pets, man. Dick's Sporting Good did well. That's interesting. How are they doing? We have bets on a couple of small sporting stores, but not Dick's. Yeah, no, I wouldn't chase them. Still, it's encouraging though. But they look at the guidance. There's a problem with their guidance. Viking Holdings, bad. Oh, so bad. Yes. That's really bad. So later we get Allegiant, American Eagle, Storage, Salesforce. Then Thursday is the big stuff. We get Best Buy is a huge one. Burlington, Dollar General, Foot Locker, who we have, Kohl's. Wow. Costco is always a big bellwether. Dell, AI adjacent. Gap, I like Gap. Guess. Marvell is more chips. We'll see how they're doing. NTAP, Nordstrom. I think Nordstrom's struggling. Because you hear, and this is also important for the economy, by the way. So you hear Target telling you that they're benefiting from, and Walmart too, are benefiting from upper middle class customers going to Target. They're looking to cut down. They're substituting what they're buying at Nordstrom's for what they're buying at Target. But they're buying the same number of dresses. They might buy 2 instead of 1 because 2 are $50 each and 1 is at Nordstrom is $700. So it's an easy way to cut back when you can get away with it. But the reality for the economy, though, is what happens. Well, there's less money being put into retail, right? So it's possible that you see Walmart and Target benefit and Nordstrom is detrimental, but the bottom line is they were going to sell a $700 dress and now instead Target sold $100 worth of dresses to the same person. So $600 is sucked out of the economy. That's the net effect there. It doesn't circulate because those people need it for other things like the frickin' $1,000 a night hotel rooms where it used to be $500 a night, things like that. So that is the state of the economy. And speaking of which, I need to head off to motor vehicles and pay them whatever it costs to renew my license. Thank you guys all for coming, and we'll do this again next week. All right, take care, everybody. Nope, wait, let's see if we have a question before I go. No question, apparently. Okay, all right, take care, folks. Bye.